Okay, let's get started with this. Just switched on the recording, so we're going to be making a recording of this. We're going to share that with some more people who couldn't attend, and in case you want to listen to it again, that is absolutely, fine. So we'll be sending the link of the recording to you. Some people may still be joining, so you'll hear a bell go off every now and then. But let me just tee this up so we can get started. So welcome to this conference call. We're very much appreciative to make time for it. Today we'd like to, like last time we did, we'd like to have a rather relaxed and informal conversation. This time it's just not Zin and myself, but we also have Funmi, Akinluyi, and Peter Pavlov. Very briefly introduce the people on the call. Well, Zin Bekkali is the founder and the CEO of SilkInvest. He oversees SilkInvest business and investment operations. We have Funmi Akinluyi, who is originally from Nigeria, and she is our lead manager in what we call the public markets or the listed markets. She oversees our investments in equities and frontier markets. And we have Peter Pavlov, who is with us to manage. He wears two hats, really. First of all, he manages our real asset strategy, which invests in assets which are positively correlated with inflation, and the investment case is all about the supply demand and the scarcity thanks to a rising global demand. Peter also helps us out by providing our investors and our clients and our prospects with deeper insight into our portfolio, our risk management, and so on. And then there's myself. I head up marketing and business development at SilkInvest. So just before we get started, you'll see, if you're online, you'll see a screen in front of you. That screen contains information about what we're going to be talking about today. And if you would be up for it, also, if you have a question for us, now we're in a fairly petit comité, so I think we can turn off the mutes. If you have any questions, by all means, please do let us know. But if you prefer to send us a question via email, my email is on that screen. So enough of that. Let's get started. Zin, why don't we start with you? So we find ourselves, the reason why we set up this call is because there's so much going on in the market. It's getting kind of crazy. What's the overall view from your side?
Thanks, by the way. I don't want to, jump too much on some of the highlights that Funmi and Peter will share. I think the key thing is, as we mentioned last time, is that we're really waiting for some type of a movement or that the markets will move from beyond a normalization that is currently happening with regards to the interest rates and inflation numbers in the US, to a more normalized world where investors need to accept the reality of a combination of high interest rates, higher inflation, and more volatility. And whether the volatility is driven by politics or not, that is to be seen. But that's basically really the thing which, for my humble opinion, is really the most important element that people need to look into, is that this holy triangle of increased volatility, increased inflation, and increased interest rates. And in that regard, I strongly believe, and that's been our conviction for a long period of time, I must say, but we believe even more today than in the past, that frontier markets are very, very well positioned for that. And similarly, or in parallel, some of the real assets that Peter will talk about also could be a very interesting solution for investors. But by the way, I think that I can keep it at this stage, at this level, and I'm happy to jump in later after Peter and Funmi have given some of their comments on what they see.
Sounds great. Okay, thanks for that, Zin. So Peter, maybe let's go to you now, because the first point on the agenda today, and it's maybe a good place to start, is there's a change in the volatility regime. I mean, it's not the first time we're seeing inflation and interest rates rising, but what's so interesting about this time? What's on your mind, Peter?
Well, good morning, good afternoon, everyone. It is not so much. It is effectively not the first time we are seeing all this. What was surprising was the velocity of the phenomenon we just saw. What was surprising was that interest rates have been able to move by 40 basis points in 6 weeks or 7 weeks time in the US, and at the same time we have seen almost nothing happening in the credit space. So it is all about a new era. I mean, the end of low interest rates is probably behind us, and also the volatility regime is shifting. We have had a warning at the end of January this year, beginning of February this year, with a lot of structured products betting on low volatility that helped to drive VIX to 50, 60. And all of a sudden, investors start to realize that what we had at the end of last year was probably a low point for this cycle in terms of volatility. So it is kind of the velocity and the speed of the increase in interest rates caused a lot of dislocations in several markets. We can talk a bit later on, but even some not abnormal things happened, like utilities outperforming in that environment while technology names underperforming significantly. And this is going to take time to be solved and to be well analyzed by people, but eventually common sense should prevail. Main message is that it is a change in volatility regime, but world economy and US economy, Europe economy, it's not really broken. So it is just a change of perception.
Interesting, yeah. So, I mean, what's the thing that's mostly on your mind right now? For example, you look at all these variables because you're in the real asset space, and it's almost like a set of dominoes or a way. We just before this call, you may have seen in your inbox a little hint that we found in the gold market, which is really interesting. Why it's setting up for a big move. But what's mostly on your mind these days, Peter?
It has a lot to do with positioning. Before the latest correction started in the US stock market, we have had record high open positions on the futures, long of course. We had also, as you just mentioned, we also saw record high net shorts from speculators on the gold market, while a lot of factors are in there that could eventually suggest that gold should be seen as a safe haven, which has not been the case for a couple of years now. And also, what we have seen is that despite all the turbulence in emerging markets, we witnessed over the summer, we have seen a significant contraction in spreads on external debt. So there is still a lot of money in the system. It is a bit less easy money that it used to be during the past couple of years, but that money is still finding ways and places to be invested in. So it is just taking a bit more time, and eventually it is a bit more complicated.
All right, so let's maybe go to Funmi to see what's on Funmi's mind these days. Funmi, you run a portfolio which invests in the frontier markets. Some of them are emerging markets. You have a selection of markets that you focus on. What's on your mind?
Well, like Zin hinted, it's been an interesting year, to say the least. We've seen the oil price, higher interest rates, geopolitical tension, trade war, rising interest rates, all taking the focus off the fundamentals and changes that are happening in our various markets. And we think we will get to a point where fundamentals go back to play. We think, and if you look at a lot of the reforms being done in our space, they're largely positive. And for us, that's where we think we would see the most opportunity within countries that are doing the right thing. And we would see maybe not the whole blanket frontier get repriced, but we would see pockets of opportunity, being taken by investors going forward as we go back to this new regime of higher interest rates in the US. And we can go through some of these countries. If you look at how Egypt in particular has done, you would see that it's gone through the shocks that we saw largely years ago, but we expect that we would see higher profits coming through from the companies. Valuation is quite cheap, and for us that is what is key. Remembering that DM, the developed markets, is trading at stretch valuations. You have the US at 6 times, forward PE of 16 times. You have global at about 14 times. Then you have FM at about 10 times with a dividend yield of about 4 to 5%. I think it's important we look at the fundamentals. And going back to what we've seen, it's almost a flip, because in the past, I remember conversations we used to have about the political confusion in the developing markets. That's what we're getting now in developed markets. And also emerging markets seem to be moving in the right direction. Valuations, like I mentioned, are very attractive, and they continue to trade at a discount. Yes, we're no longer at the period where we had the premium frontier markets had to the world index, but we think when we do have investors focusing back on the fundamentals, we would see the markets tend to rally. Maybe not collectively.
You made an interesting point.
Countries would do well.
You made an interesting point there that, if you want political uncertainty and confusion, look at the developed markets. You said something earlier on, which I think is worth exploring and possibly calling Zin and Peter back into the conversation about this. But you mentioned something about traditionally investors think, okay, so US interest rates are going to rise, so we have to stay out of emerging markets. But I know that we have quite another view on this. I know Zin has a very strong view on this. Can you share that with us, Zin?
Yeah, I think Baldwin, I think the truth of the matter is that you have almost like 2 cycles within an interest rates increase scenario. And the first one is a bit painful. So what we have seen over the last few months, and also as Peter explained very well, is that we had the cycle where it's moved maybe very fastly and more quickly than many expected. But beyond that, when you move into the next cycle where people have higher interest rate, the question is, what do investors then do with the interest, the higher interest rates proceeds that they are receiving? So imagine like an average person on the streets who has a bond which is now returning 3 or 4 or maybe 5% in the future coupon. Is what will he do with that money? And that money, we believe that a lot of it will be reinvested instead of, let's say, the traditional markets, will be invested in the riskier market. And we have seen some of that over the years. And a lot of people make the confuse basically the initial stages of a higher interest rates with the longer trend where you have higher interest rate environments during a longer period typically tend to be good for riskier asset classes. Let me also, by the way, take a step back because, to a certain degree, all of us have big asset allocation decisions to make. And to a certain degree, that's really the most important thing that we are paid for. And if you look at today of the last 10 years, if you just have a hard look at the numbers, you see developed markets and especially the Americans, the US market did around 10-11% annualized over the last 10 years. That's excluding dividends. If you look at emerging markets, they did at around 5% annualized. If you look at frontier markets as we stand today in dollar terms, is -3% annualized. So over the last 10 years, things really didn't work the way they should work. And the two reasons for that are really have to do with two items. One is the multiples, as Funmi has explained, and the other one has to do with currencies. Now, currency is a very important factor because it really relates to a very important element of our story, is the fact that a lot of frontier markets and a lot of emerging markets have taken difficult steps to reposition their economies, restructure their economies, and make them more competitive. So if you look at the typical country, Egypt's one example, is a lot of countries are now closer to their real effective exchange rate. Lots of countries have done a lot of good work in terms of the deficit management, increasing taxes. A lot of countries have done good work in terms of increasing their FX reserves. But a lot of countries are basically better positioned. Moreover, we are living in a different world, and anybody who wants to test that hypothesis just have to think about, the difference between how capital markets have reacted to the trade wars versus the economics. I mean, China is still growing 6-7%. Okay, the stock market went down, but we should not again confuse how stock markets behave with the economic reality. And the key question for investors to ask themselves is, what is the better bet for the next couple of years? Question is, what's the best thing for the next month? Okay, that's a bit more complicated. But for the next few years, there is a very logical case to invest your money in countries which have a higher dividend yield, a higher or lower PE levels, and economies which are growing faster and which are managed better in a more structured manner. And we believe that a lot of people, the financial assets of the world are in the US, are in Europe. So basically, these are the people who are going to have higher interest rates or higher coupons. Now, these people will make a decision on what to put that money, and they will put it increasingly in our countries, in our FM and emerging markets, and also in some of the real assets, because there's another, again, a very important point is that inflation will be rising, and it will be rising because of interest rates, but also it will be simply rising because of lots of the decisions that are being taken today are inflation positive, we want to call it. Trade wars will mean more inflation, full stop. That's the reality of it. The more broader theme of the political volatility will create more inflation. So that's in a summary, by the way, what our view is on this.
So we're speaking about inflation, Peter. What are you? How do you see the inflation building out? I mean, Zin mentioned the political uncertainty. There's a historical correlation between rising uncertainty and the rise in inflation afterwards. But what are you looking at these days to gauge inflation?
I'm looking at the CPI.
That's a very simple answer.
Much more complicated than this. As we all know, monetarists will argue that inflation is always a monetary phenomenon. Actually, it is maybe a bit more complicated than this, because over the past couple of years, we have seen monetary base increasing significantly to levels not seen before. But at the same time, we had a couple of factors that worked the other way around, and meaning money velocity, meaning globalization, etc. Today, at this inflection point, we believe that it is an inflection point because we have seen actually a rise in populism around the world, which is translating into higher fiscal and monetary impulse at a time where there should not be such an elevated positive impulse coming from those areas. At the same time, we're also seeing a continuous increase in demand for raw materials, and in many cases the output gap that used to absorb all that pressure over the past 10 years is almost closed. As it can be seen in the US, where the unemployment rate is almost to lowest ever. Lowest ever was 3.5% in the 60s. So, which was quoted as the golden era of the post-war environment. But the main lesson for that from that episode is that after that we got record high inflation, which was caused by external factors like oil, etc. But it existed. Something really equally important is that traditional correlations don't react in the same way within a low inflation regime when compared to a high inflation regime. Typically, over the last 30 years, we lived in a world where inflation tended to decline significantly. It was either low or declining, and bonds and equities in general use it to exhibit negative correlation, and the typical 60-40 or 50-50 portfolio was really a very nice way to generate returns and to balance expectations of future growth, and also to mitigate volatility of those returns. What we have seen over the past couple of weeks and months is that actually people are less prepared, and some of them even don't know how to position a portfolio when we have a simultaneous crash in the bond market and on the equity market as well. All of a sudden, those two asset classes recorrelated. And this is also an indication that given higher inflationary regime, we should maybe revisit our books and how we manage our portfolios and where we invest in.
All right, thanks, Peter. Funmi, let's go back to you now. So let's get a little bit more specific and concrete. So in your equity portfolio, where are you currently? What are your bets look like? Where are you putting money to work, and what are you avoiding, and why?
Okay, I would say, first of all, let's find out why some of these countries are particularly interesting in the first place, and then we'll move to where and why. If you look at the valuation of a lot of our markets, you see that a lot of the markets in the frontier space haven't done particularly well. If you look at valuations, you see valuations in Asia in particular, and that's Vietnam and Bangladesh, remain relatively high compared to the other frontier markets. You have countries like Nigeria still at 6 times with dividend yields of close to 7%. You have Kenya at 9 times with dividend yield of about 6%. And then you have the GCC, which hasn't seen much traction this year. Then you have Egypt, right? Egypt that went through the devaluation we saw in 2016, and that has more or less refocused the market space for Egypt, because we've gone from having relatively expensive companies to having cheaper companies in the long run. If you see our universe, you'd see that overall, and this we do periodically, you see the opportunities within the banking space in Africa, and you see the relative net interest margins being made. In many of the companies, it goes as high as 16%, and all the banks are doing is lending to the government. So Baldwin, you were going to, I was waiting for you to ask me about inflation in my universe.
Let's do that.
Side.
Yeah, absolutely.
What that is translating into is the fact that a lot of our governments cannot cut interest rates to help push the GDP even further. So it's curtailed a lot of the growth we could see internally. But even with that difficulty, we still expect EM developing and frontier markets to still grow. at almost 2 times that of developed markets. So we need to understand how difficult many of the countries are working. But once some of these factors change, it'll be easy for them to go back to their previous growth potential. But then you look at places like Egypt, Kenya, Vietnam is a very good example, and they continue to grow quite well. When we look at and Zin highlighted this, the real exchange rate for many of these countries, you see that they're trading at less than fair value, and many of them close to fair value. So obviously that does help with exports.
So you're saying that they're ahead of the curve.
We also have imported inflation coming in from net importers of crude and things like that. And obviously that translates to higher interest rates for them. But we expect that when we do have a normalized environment, and we do have, I would say, reasonably priced oil, we would see a lot of these countries actually look to push down rates quite aggressively. And obviously that means that the banks that I like, that are getting the easy net interest margins, would have to look for clever ways to make money. Maybe that will force them to start to push loans out to the real economy, which we are not seeing at the moment.
All right. Just to kind of round up, because we also want to hear some questions if there are any. But just quickly for me, like what are like the top 3 or top 5 ideas right now? What are the most hated ideas for you? Just quickly.
Consumer Egypt, banks, Sub-Saharan Africa, especially Nigeria, and then telecoms within Africa at reasonable valuation. I would say in terms of what to hate, I wouldn't say there's a theme, but obviously high-priced companies are not going to do well in the cycle we're going into. I think the focus is now on how to capture valuations at reasonable prices, and focus on companies that have strong dividends and can give you overall a defensive stance going into 2019.
So dividend-paying companies is the norm?
I would say, obviously, no, because the valuation is so
low, yeah.
Yeah, lower at the moment. You can get this well-run companies at reasonable price and at with very good dividend yield. So it's worth exploring that. Yeah.
I see. Okay, thanks. Before we go to questions, Peter, any things that you want to highlight right now?
Yeah, current environment is clearly providing a lot of opportunities. We already touched on gold. There is actually another sector where we are seeing a dislocation, which is related to the US housing market. Rising interest rates and the speed of that increase caused wood producers, as an example, to suffer significantly. In some cases, stock prices declining by 40-50%. There is one company, or whatever, no, I will not cite any name, but now Canadian wood producers typically trade at PE of 5. Next year PE is 4.5 to 6. So clearly opportunities arise in selected areas of the market. And it is a contrarian play. It is, even when we look at the consensus, it is rated as a hold.
Gotcha. All right. I'm going to unmute you all. So in case you have any questions, please just dive in. Let's see. Anybody have a question?
Yeah, this is Charlie Gushy. Can you hear me?
Yes, Charlie. Thank you.
Yeah, just, sort of a very big picture one that I'm looking at. I mean, one thing that's very clear, I think, is that there's a gradual slowdown going on now and ahead of us on Chinese GDP. So how would you position for that? What's the impact going to be on markets? You know, I mean, how to play going forward?
Yeah, I'm happy to take that. And you see that as you know, is the China GDP story is almost like every time they release another angle to the growth theme that they have been managing now for a couple of decennia. And the key question that I think anybody needs to ask himself or herself is, what is the next China target growth rate? Now, if it is 6%, which is below the current trend line, then we should not be too worried, because there's a lot. 6% for one of the biggest economies in the world is a lot. So my question to anybody is like really to think through, what is it that they are looking into? Are they thinking about their portfolio in a situation where China will grow 2%, or is it like a slight decrease and move into 6%? Because that gives you two completely different answers. So maybe before I go further, so what is your hypothesis? Is it like going from 7 to 6, or is it from very low number?
Yeah, I agree with you. And when I hear, in particular, the analysis of the debt overhang in China, it smells very similar to the the ancient Japanese widowmaker trade, right? Of there's so much debt, the country must be about to go bust. But it looks to me structurally like China is very similar to how Japan was going back 20 years and still is, which is a pretty sustainable debt management issue rather than a looming blow up. So I'm in your camp, but it makes me nervous that I hear that comment a lot from people, frankly.
Yeah, I mean, that angle on the debt, I mean, if there's any problem with the debt, I think, as you know, the issues are closer to home. I'm sure what all of you know is that the recent annual increases in debt levels in the US is higher than the increase in GDP. So as much as, again, we always have to be very, very much thinking things through, is that in the US, the annual increase in debt over the last few years has been higher than the increase in GDP. Very different picture in China. As much as the debt has increased, but the GDP has increased even further. So in a world where China continues, let's say, to grow at a certain level, and you have other countries growing, and sometimes growing faster. As you all know, India is still growing and growing faster, although maybe less than the initial years of Modi. You have other emerging markets catching up. So the truth of it, from a pure GDP point of view and a pure growth point of view, EM/FM story has delivered even over the last 10 years. The problem that didn't happen, obviously, is that the stock market didn't recognize it. And so the question is really around, are there any catalysts for investors to return to emerging markets with their money? So it's not a GDP question as much as it is like a question around what's going to be supportive of the markets. And I think the answer to that from our from our humble opinion, is like a combination of below historical levels of valuation levels, increased local financial assets, plus returning international investors, make the case for a very strong picture or strong upcoming momentum in this country. So I also want to add one more thing, is really around the real asset story that Peter has spoken about. Is, a lot of those things sometimes are very theoretical, but it's really around understanding how some of those consumer-driven stories will impact demand for things like timber and things like for energy and water. Those are going to be a big stories going forward, because that is like really the reality of it. And as much as technical innovation is helpful, but the demand side will continue to grow. And unfortunately, many of those assets will not be there when we need them.
All right, thanks. Any other questions? I actually have one. Okay, so we have this concern about trade wars, and there seems to be this divide. And what I would say is like when you have certain economies or countries that can't do business with each other because of embargoes and so on, for me, there's always this one clear winner in this game, and that's the Middle East. It's like Dubai or a place like that, because despite embargoes and trade limitations, if you would want to sell or buy something from a country that you're not supposed to be selling or buying, first you sell it to the Middle East, and then they'll do the other side of the trade. So why is the Dubai market in particular not picking up on this? Why is this not being played? You guys have an idea why?
Yeah, I'm happy to also answer. It's really, your statement is correct. So normally in a normal environment, Middle East would have been one of the best markets to be in for the last actually 2 years, since, let's say, reaching the lows in the oil prices and returning to this type of more volatile environments. The truth of it, because of localized situations like the one we had in Qatar, that didn't happen, that didn't materialize. But valuations are very, very interesting, and especially in UAE, you have a company, for example, like Emaar trading as a P of 6. You have very nice interest rate area, but trading at a dividend yield of 10%. So those are like very good stories to take into. And as this localized factors, as long as they don't blow up, and of course in the Middle East you always have potential for them to blow up, I think the Middle Eastern markets are one of the most attractive to put some money in.
I'd just like to chime in that there could be the market pricing in the looming addition of Saudi into EM also.
Correct. Yes,
Yeah.
I totally agree. There was a lot of attention to that. And what we saw was collectively people selling down in the whole MENA and especially GCC and offloading to Saudi.
Right. We'll see what they do now.
No, I think, like I mentioned, it goes back to fundamentals. It's now looking at companies that are well priced and preparing for the possible cycle where these companies deliver on earnings and people start to refocus on them.
Yeah, and we did some of that in the sense that we have actually taken some profits in Saudi before this whole mess in Turkey happened. Yes. Because of the point that you made about this EM-FM situation. We believe that most of the upside, the structural upside in Saudi, let's say, is gone, and that you are better off investing in other markets. And that's really how we at least position ourselves. And we think that the market will follow. We have seen some of that, like in Qatar, where you had first a big correction and there was limited flows. But it's one of the better markets this year. And we believe next year probably UAE is one of the candidates to show a similar outperformance within the Middle Eastern markets.
Yeah, Saudi is at 13 times, dividend yield of 4. UAE is at 8 times, dividend yield of 6%. And given that they're largely safer, in terms of FX, you have the close links to the US dollar. You can also play the FX projections that way also.
Yeah, absolutely. That's one.
Yeah, if there's concerns about FX depreciation in some of these markets.
Well, that's the big question, isn't it? Higher dollar, lower dollar, and the same question about gold. All right, so we're 45 minutes in. Unless there's any more questions, ask now or silence forever. Just kidding. All right, well, let's. Sorry, Juan, was that you?
No, sorry. I just want to say thank you.
Well, thank you for being here, all of you. Really appreciate that you took the time. Again, like I mentioned, we have a recording of this, so look out for it in your inbox. We'll send you a link. Feel free to share this with people you think may be interested in it, or if you want to listen to it again. And we're going to be doing this again quite soon. In fact, we really enjoy doing it, so you're probably going to get us in this kind of setting more often. So again, thanks very much for coming to this conference call, and Zin, Peter, and Funmi, thanks for your time.